Sorry, I'll start that again. I was on mute and didn't realise it, so I was speaking to myself. Good afternoon, everybody. Just a couple of things to be aware of. The webinar is being recorded this afternoon and will be distributed together with the slides in the next day or so. All of the attendees, unfortunately for you, you just have to listen to me today. Your own mics are muted and the cameras are off, so all I can see are my slides. I can't see you. I'm hoping to have a question and answer session towards the end, but that very much depends on how much time we manage, how much subject matter we manage to get through this afternoon, because there is quite a lot I want to go through. By all means, do ask questions throughout the session. We will be collating those at the end, and again, the idea is that hopefully I'll give you some feedback on some of those questions if I'm not able to answer them today. So if we could move on to the next slide, please, Dan. Right, as you can see, there's a number of areas to cover today. I want to look at some recent case law, and a couple of those there you'll recognise are old cases that are outstanding, but I'll just give you some update. We'll talk about general things that are affecting the charity sector at the moment, in particular annual adjustments and capital goods schemes. We'll look at a consultation that Revenue are doing. I'll update you on the introduction of the construction industry reverse charge, what you need to be doing when the temporary 5% rate finishes, and then what to do if you've deferred your VAT payment and the extension that's been provided. And then we'll briefly touch on Brexit, which is a subject in itself, and then what you need to do about getting ready for making tax digital. So they're the main areas that we want to go through. Go next slide, please. So I'll start off with the Colchester Institute Corporation case. And this is one of those cases that has caused a bit of a problem, and it's one that I don't think Revenue like, even though they won the case. We certainly don't like it. And it's one of these cases that you think, what do we need to do with it? It came out just before Christmas, so completely ruined my Christmas meal when I saw it come out, because I looked at it, put it down, looked at it, and I keep wondering, is that really what they meant? So let's go through exactly what this case was all about, and we can consider how it might impact on you. The college was providing, or is providing, educational services to 16 to 19-year-old students. Some of the students pay the fees themselves. Other students receive funding or part funding from the EFA and the SFA, now commonly known as the ESFA. Now, Revenue's policy on grant-funded education was always that, as this is not consideration for any supply, this was deemed to be a non-business activity, so the grant funding was outside the scope of VAT. Where you do have educational services provided in return for fees, that's normally an exempt supply, as long as it's provided by an eligible body, which clearly the college would be. Next slide, please. Now, back in 2008, the college was going to undertake a major campus development at a cost of around 100 million. Now, as you can imagine, as the college is either making exempt supplies or non-business supplies, it's not able to recover the VAT incurred on those costs. However, back in those days, there was something called the Lenart's mechanism, for those of you that can remember it. And what the Lenart's mechanism allowed you to do was be able to reclaim VAT incurred on your non-business activities up front, and then over a period of time pay back that VAT based on that non-business use. And that was based on over the lifetime of the asset. So what the Lenart's mechanism actually did was give you a cash flow benefit. You recover all your VAT up front, and then over the life of the asset, you pay some of that money back to Revenue. In 2004, the college took some advice, and the advisor took the position that actually the college didn't have to account for output tax, because the advisor believed that the funding that the college was receiving from the EFA and the SFA was actually consideration for the provision of services. And so the college submitted a retrospective claim going back 4 years. He argued that the funding was payment for exempt supplies, and therefore, because the college was making exempt supplies, there was no non-business activity, therefore shouldn't be making payments under Lenart's. Next slide. At the same time, the college argued there was no need to adjust the VAT that had already been recovered because that was now out of time. If you remember, they recovered the VAT in 2008 and were now submitting a claim in 2014. So they were arguing, yes, we want our cake and eat it effectively. Revenue, as you can imagine, rejected the claim and CIC appealed. It went to tribunal and the tribunal found in favour of revenue. It agreed with revenue that the funding received from the EFA was actually grant funding and therefore the education was a non-business activity. The college appealed this further and rather surprisingly, the upper tribunal actually found in favour of the college. It took the view that the funding that was being provided by the EFA was actually third-party consideration for the provision of education, and therefore it agreed with the college that there was no need to have been making those payments under Lenart's. Next slide, please. However, that wasn't the end of the case. Revenue argued that actually if you're saying there's no liability to account for output tax, then there shouldn't be any entitlement to input tax recovery, i.e. the original Lenart's claims. So was the college right in this? The answer to that is no. There is specific VAT legislation that requires all the consequences of a mistake to be adjusted. So effectively you can't have a situation where if you've got no output tax liability, somehow you don't adjust your input tax, regardless of whether there's a 4-year cap there. And so therefore, the college lost on that point. Next slide, please. Now, because revenue have won this case, it's unlikely that they'll be appealing this particular case further. However, it has left us all with a bit of a dilemma. In particular, if ESFA funding now is not deemed to be grant funding and is actually third-party consideration for services, what happens if the actual services aren't exempt, such as educational services, but the service is actually standard rated? Similarly, it potentially causes us a problem with the zero rate reliefs, because let's not forget, a lot of the zero rate reliefs are predicated on the fact that a building might be used for non-business purposes. So typically, if a college is constructing a brand new building and it was used solely for non-business purposes, it can get zero rating. Well, if the position is now that actually that funding is consideration for a supply, potentially we lose the right to the zero rate relief, and similarly the zero rate relief for fuel and power. And then finally, what's the impact on school academies? Again, there's a specific refund scheme for school academies, so they are a special case. But again, that refund scheme is based on the fact that the funding from the ESFA and government funding that's given to it is deemed to be grant funding outside the scope of VAT, and therefore the academies are undertaking non-business activities. My own personal view is I think it's highly unlikely that academies will be impacted on this. However, the case itself has left us in a little bit of uncertain territory. I know for a fact that revenue aren't happy with the decision. It's odd to find revenue winning a case but not being happy with the decision, but that's where we are. There are lots of cases stood behind the CIC case. I think there was something like 16 or 17 cases stood behind it. What we may see happen here is that some other organisation has slightly different circumstances and therefore there may be further litigation. However, we hope that revenue would issue some updated guidance, but in the meantime I think all we can do is proceed with revenue's published guidance and use the reliefs that are available for now, but keep a watchful eye on what happens as a result of this case. Okay, next slide please, Dan. Okay, I've got a case listed here which I can't name because it's actually one of our own clients. We've got a case going to tribunal ourselves, and it's a client that provides hostel accommodation for the homeless, and the homeless person staying in the hostel have a license agreement to be able to stay in there. Now, revenue initially argued that the provision of the accommodation in the hostel was exempt, and that was because it was seen as ancillary to the provision of welfare services. So there was an element of care being provided as far as revenue were concerned. Revenue looked at the details in a bit more, and they actually said there aren't any welfare services provided, and therefore the hostel accommodation is standard rated on the basis it's similar to hotel type accommodation. Revenue went away, but then they came back again and said, actually, in hindsight, we think, yes, VAT is due, but not on the basis that there's hotel-like accommodation provided under a license to occupy. Now, you may think, why is that important? Next slide, please, Dan. Now, if we look at the technical aspects of this, now ordinarily the grant of an interest is land is exempt, but there are specific exclusions from that exemption. And one of the exclusions being hotel or hostel type accommodation. So because it's excluded from the exemption, it's automatically standard rated. But there is a special rule for hotel hostel type accommodation that's excluded under this part of the legislation. And this is referred to as the 28-day rule. Now, if you haven't got a grant of an interest in land, you can't use this special rule. So what is the special rule? And if you can just, next slide, please. What the 28-day rule does is it allows operators of hotels or hostels to account for a reduced value in respect of their VAT after 28 days. So from the 29th day onwards, anyone staying in a hotel wouldn't be charged VAT on the accommodation element. They'd only be charged VAT on things like catering or laundry services or any other ancillary services that they might have. So the importance of this case is, if revenue are right, that you can't, this doesn't fall within the exemption schedule, and therefore you can't use the 28-day rule. Whereas if the charity is correct, you have got a grant of an interest in land and therefore license to occupy, and therefore you can use the 28-day rule. Next slide, please. So as I say, this case is due to be heard in March, and it's quite important from our perspective because depending on what comes out of this, we may get a reinterpretation of what is meant by a license to occupy. And one of the points, interestingly, that Revenue relied on in this case for reaching their conclusion is that the license agreement itself stated that there was no landlord-tenancy relationship between the parties, and similarly, the license wasn't intended to confer any exclusive occupation to the tenant. Now, one simple solution may be to remove those clauses from the agreement, but that may cause other practical implications to the charity itself. So, as I say, the case is to be heard in March. Hopefully, we'll see what happens with this one. Next slide, please. Next case I want to talk about is the Royal Opera House case, and many of you will be aware that this case has been sitting around for some time. And just to refresh our memories on the Royal Opera House, the case was all about the recovery of VAT on production costs, and historically Revenue had always taken the view that VAT incurred on production costs could never be recovered because the production costs were directly attributable to the exempt ticket sales. Following litigation in Mayflower Theatre and Garsington, Revenue changed their position and they issued a business brief back in 2009, whereby they accepted that VAT incurred on production costs can be partly recoverable. However, they also said that you can't use the standard method, and the standard method is based on taxable turnover divided by taxable plus exempt turnover, to work out what proportion of the production cost should be recovered. Revenue always took the view that production costs didn't have a direct link to any bar or catering income, and therefore you should be using a different calculation to work out what proportion of your production costs you could recover, i.e. you've applied an override. We'll go on to the next slide, please. Royal Opera House submitted a retrospective claim, basically recalculating the VAT they'd recovered by including things like bar and catering income in their calculations. They appealed to the First Tier Tribunal. First Tier Tribunal found in favour of Royal Opera House. They accepted that there was a link with bar and catering income and therefore should be included in the turnover calculations, but unfortunately for them, Revenue appealed to the Upper Tribunal. Next slide, please. The Upper Tribunal took a detailed review of the case law, and it actually concluded there was two bases for establishing whether there was a link to taxable supplies. They distinguished between general overhead costs, where it's right that what a taxpayer should do is look at their economic activity as a whole, and instances where actually what you have are residual costs, and therefore what you have to consider is whether the costs that you're considering have a specific link to specific taxable transactions. And what the upper tribunal said is, in order to be able to recover VAT in those circumstances, the costs need to be a cost component of that taxable transaction. Next slide, please. Now, both the Royal Opera House and Revenue agreed that what we had here in terms of production costs weren't overhead costs, they were residual costs. However, the upper tribunal found in favour of Revenue. The upper tribunal said that there was no direct link between production costs and catering and bar income, and therefore could not be included in the calculation. The Opera House's argument was that the production costs attracted people to the bars and to the catering, and the catering income and bar income that was generated was ultimately used to fund the productions themselves. So you had this virtuous circle where both things were reliant on each other. Unfortunately for them, the upper tribunal didn't accept that. Now, the case was heard last week in the Court of Appeal. So hopefully within the next couple of months, I expect the Court of Appeal will give its decision and we'll have some clarity on this particular issue. But interestingly, Revenue have gone back to their, I understand from that hearing that Revenue have gone back to their old argument and saying that if you have an exempt supply, that effectively is a chain breaking event. And so production costs could never be recovered. So it'll be interesting to see what comes out of that one. Next slide, please. Okay, and then finally, in terms of case law, I just want to touch on News Corp. News Corp publishes newspapers such as the Sunday Times, as well as digital versions of the publication. Now, there's no dispute that the hard copy versions, the physical publications, can be zero rated. What we needed to consider was, what about the e-publications? Now, News Corp lost their case in the first tier tribunal. The first tier tribunal reaching the conclusion that actually the legislation only allowed for zero rating of goods, not services, which is what e-publications are. Case went to the upper tribunal, and the upper tribunal found in favour of News Corp this time. It threw out the first tier tribunal's decision using something called the always speaking principle. And what the always speaking principle says is that the law should be interpreted within the context of what the legislation was intended to produce. Revenue appealed. Next slide, please. Revenue appealed to the Court of Appeal, and the Court of Appeal has found that the zero rate provisions only apply to goods. So we've gone back to square one. Now, News Corp also made representations about fiscal neutrality, but interestingly, the court said that this principle only applied where similar supplies were made by different suppliers, not the situation that we have here, where you have News Corp supplying both the newspapers and the digital versions. Now, hopefully most of you will be aware that since the 1st of May 2020, the legislation was changed in any event to now allow for zero rating of e-publications. But as you can imagine, there's a number of cases that were stood behind News Corp because a lot of organisations submitted retrospective claims. Now, again, although the Court of Appeal has given its decision in the last couple of weeks, we understand that News Corp has actually sought permission to appeal to the Supreme Court. So anybody that's got a retrospective claim in place, please don't rip up your betting slips just yet. There's still more litigation to be had on this one. Whether they get permission or not, I don't know, but as I say, this one is still ongoing. Okay, we'll move on to the next slide, and I think that's enough on case law for the moment. A topic that's high on the agenda of many charitable organisations. We're in partial exemption and VAT recovery annual adjustment periods right now. This is the season when all of you will be thinking about undertaking your annual adjustments, which is normally period ends 31st of March, April or May. So what we do need from Revenue is some clarity as to what we should be doing. Now, Obviously, COVID has caused distortion of local trade, of normal trade. We've got charity shops that have been closed, so therefore the taxable income from those activities has been lost. We've had museums and galleries, theatres haven't been open, so therefore reduced ticket sales. We've had universities closed, therefore their trading subsidiaries haven't been able to operate. So we've got a mixed bag of implications here as a result of COVID. We don't have a normal trading year. So what do we need to be thinking about? Sorry, yeah, next slide. You're ahead of me, Dan. Well done. Kinds of questions I've been asked. I've had a theatre client say to me, well, given that we've been closed for the last year, we haven't had any exempt ticket income coming in. The only income that we've had is actually sponsorship income. So does that mean I can now recover more or less 95% of the VAT on our expenditure? I've had another charity client who's got a number of charity shops across the country. All of that taxable income has been lost, so their VAT recovery rate has been halved. And I've had a university where their trading subsidiary hasn't been able to provide any bespoke training to businesses, and so therefore big chunk of taxable income has been lost, and their recovery percentage has dropped by more than 20%. Now, as well as the impact on partial exemption calculations, there's also a direct impact on capital goods scheme adjustments. Because again, for those of you that have to undertake those capital goods scheme adjustments, those adjustments are impacted by whatever your VAT recovery rate is. So you do your annual adjustment, you work out your VAT recovery rate for the year, and then that's what's actually used to undertake your capital goods scheme adjustment, unless you've got agreement to do something else. So what do we need to do? Next slide, please. I think one of the first things you need to consider is whether or not you can apply an override, and that's dependent on whether you're using a standard method or a special method. If you're using a standard method, there is a standard method override that you could consider. If you're using a special method, again, there is a special method override that can be considered. I do have concerns about triggering a special method override, and the reasons for that is if you trigger a special method override, you've then got to go to the trouble of trying to get agreement with revenue to use an alternative special method. So that could be a bit of a problem. One of the points that I would consider is whether or not what you might want to think about doing is looking at what your annual adjustment recovery rate has been for the last 2 to 3 years, and maybe use that as an average and use that to do your calculation. However, I can't professionally and formally advise you to do that because unfortunately revenue have not issued any guidance. That is just my thought on what I think might be a fair approach. Lots of organisations have been badgering revenue to give some guidance because ultimately all organisations have still got an intention to carry on undertaking their normal trading activities, their normal business activities. It's just that COVID has shut them down and government has shut them down and prevented them from operating. We keep hearing that revenue intend to issue some updated guidance, but at the time of me presenting this course, I still haven't seen anything. So anybody that wants to discuss this issue, please do contact us. We'll try and give you some guidance, but as I say, we're still waiting for revenue to clarify. Next slide, please. Okay, there's a consultation going on. I don't know if you're aware of it. It's called the VAT and value shifting consultation. This was recently announced, and the purpose of the consultation is to seek views on revising calculations that need to be undertaken when apportioning consideration that you received for suppliers with a mixed VAT liability. And a classic example that might affect the charity sector is membership subscriptions. At the moment, the legislation doesn't contain any particular way of apportioning those values. The intention of the consultation is to introduce new legislation that has specific valuation methods. And so this will be the first time we've got some clarity on this. What the consultation paper already says is that cost-based apportionments won't be permitted where items sold in the bundles are already sold separately, and therefore you do have an individual sales price already known. Okay, next slide, please. Now, as I say, the consultation could impact on a number of organisations, and the one that quickly springs to mind is membership subscriptions. There'll be lots of membership organisations who are currently apportioning their membership subscriptions between the different benefits that members are getting, some goods, some services, and the most common one that jumps out is obviously publications, regardless of whether they're e-publications, because obviously we can get those zero rated now. Now, I do know that most organisations use a method based on costs, and so this might be an area that revenue will look to challenge. And the consultation does finish on the 30th of March, so anybody affected by this and who may want to make representation, please do look at the consultation paper and see how it might impact on you, and make representation to revenue if you see fit. Okay, next slide, please, Dan. Okay, this one is coming in very, very shortly, actually, 1st of March. We haven't got that long to go. This is one of the changes that's been stop-start. It's been put off a couple of times, but it looks like this time it's certainly going to be coming in. Called the Construction Industry Reverse Charge. And the whole purpose of its introduction is to stop what's called missing trader fraud. Missing trader fraud is a classic situation. Normally, we're looking at the mobile phone industry for something like this, but it's also been rife in the construction industry according to revenue. And this is a classic situation where a supplier charges VAT to a customer, and rather than declaring that VAT in its VAT return, the supplier disappears, closes down, and runs off with the VAT without paying it to revenue. So one of the mechanisms that revenue have to try and stop that kind of situation applying is to introduce a reverse charge. And what the reverse charge does, it introduces a situation where rather than the supplier accounting for VAT, the customer accounts for VAT. So the supplier raises an invoice to the customer with a statement on there stating that the customer will account for VAT under the reverse charge. Now, the mechanism is going to apply to specified services between VAT registered entities. And there's a list of entities in revenue's guidance, but broadly we're looking at construction services as listed for the purposes of the construction industry scheme. Next slide, please. The reverse charge will apply to specified services unless the services are supplied to an end user, and there is a specific definition of an end user, which we'll look at a moment. It doesn't apply to a recipient who's making onward supplies of those construction services to a connected company. It doesn't apply to anyone who's not VAT registered or required to be VAT registered, or recipients who are not registered for the CIS, or the supplier and the recipient are landlords or tenants or vice versa. And obviously it doesn't apply in circumstances where the services themselves are already zero rated. Next slide. So an end user is a person who receives specified services for any purpose other than making an onward supply. So if you're not supplying on those services, so if you're not a third-party contractor that's sitting in the middle of a transaction, it's not going to apply to you. Where the customer has not confirmed it's an end user, either in writing, via email, or it's mentioned in the contract, then revenue's guidance says that the reverse charge will apply, and therefore no VAT is charged. Now, if we just pause there, if you're a charity and you're receiving construction services from a supplier in respect of a building that you're constructing, the reverse charge won't apply because you're an end user, and therefore the supplier will charge you VAT. However, if you don't tell your supplier you're not an end user, potentially that means that your supplier shouldn't charge you VAT, and the onus to account for that VAT shifts onto yourself. Now, whether that gives you any cash flow benefit or not, we've yet to determine, but this is what the guidance says at the moment. And it also says if your customer doesn't provide confirmation it's an end user, it cannot be treated as one. Now, any suppliers raising invoices have to make it clear on their invoice that it's the customer that has to account for VAT. As a result of this, and I don't know if any of you have already received some letters from your suppliers, but I imagine that there will be suppliers of construction services already writing to you, asking you about your status, because ultimately that's going to determine and give an indication to that supplier what kind of invoices they need to raise to you, i.e. whether it's going to be a normal invoice or a reverse charge invoice that says you're responsible for accounting for the VAT. Okay, next slide, please. End of temporary reduced rate. Seems like a long time ago now, but there was a temporary reduced rate introduced during last year, and the reduced rate of 5% was introduced mainly for admissions to attractions, and that's things like museums, galleries, theatres, zoos, amusement parks, holiday accommodation and catering, sales of food and non-alcoholic drinks. Sorry guys, only the non-alcoholic ones. The normal alcoholic drinks that we all enjoy, still liable to VAT at the normal rate. And the whole idea at the time was to boost the tourism and hospitality sector. And initially, the reduced rate applied up until the 12th of January 2021, but it's now been extended, or was extended, until the 31st of March 2021. And I have to say, we did have some fun and games with revenue at one point, because a lot of revenue officers couldn't find any guidance specifying that the period had been extended to the 31st of March, and there was nothing on Revenue's website about it. And what we had to start doing was sending copies of Rishi's announcements to Revenue just to convince them that this period had been extended. Now, this does give us a small window of opportunity, because if we apply the normal tax point rules, if you receive payment or raise an invoice prior to the 31st of March for events or accommodation or indeed catering that's going to be provided after that date, the 5% still applies. Okay, so even if you're, if for example you're selling theatre tickets, and hopefully we're going to have some theatres opening up in the next few months, but if you're selling theatre tickets for an event that's going to take place, let's say in September, and you sell those tickets now, potentially you're liable to VAT at the reduced rate. Similarly, if you're providing catering and you're raising your tickets now, you're raising your invoice now, again, we can have the VAT at the reduced rate. So we do have a small window of opportunity to be raising those invoices. Okay, next slide, please. Now, in terms of online events, we did have a few fun and games with Revenue about online events, because with theatres, we've got a situation where some theatres are deemed to be eligible bodies, and therefore their ticket sales are actually exempt. We've got other theatres that have chosen to break the exemption and come out of being an eligible body, and therefore their services are standard rated. But of course, what we also had is a situation where, because of what's been going on in the world in the last year, some theatres started putting on performances online. So as well as a live performance, we had an online performance. We had a few fun and games with Revenue, trying to convince them that actually the online performance should also be exempt rather than standard rated. Revenue initially took the view that regardless of whether we had a live event or not, that was actually a digital service rather than an admission to see a live performance. But thankfully Revenue relented and accepted that provided what you had was a performance that was being broadcast simultaneously at the same time that an event was on, then you can benefit from either the 5% rate or the exemption. If, however, it was a pre-recorded event, then Revenue's position is that is a digital service and therefore is liable to VAT at the standard rate. You can't have either the 5% or the exemption applying in those circumstances. If we take that one step further, museums and galleries, again, many museums and galleries have been closed, and some of them have resorted to having some kind of online tour of their museum or gallery rather than being able to physically visit the museum. And the question that's arisen is, well, what's the VAT liability of that supply? Again, as far as Revenue are concerned, that is an admission, that is not admission to the museum or gallery. That is actually a digital service. So if there are any theatres out there who are charging a fee for somebody to be able to look around their museum or gallery online, that's deemed to be a digital service and therefore standard rated. I'll come back to digital services in a bit when I look at Brexit. We also have schools, colleges, universities. Again, hopefully most of them are providing exempt education. But again, a lot of them have had to move into providing some of these course material online. Provided there's some kind of human interaction there, and that there's a tutor and a pupil, Revenue still accept that the exemption applies in those circumstances. Next slide, please. So what do we need to do to prepare ourselves for 31st of March? Well, one of the things that we want to do is maybe look at our pricing structure. I don't know how many organisations did actually reduce their fees to take account of the fact that actually we've got a 5% rate or a 20 rather than a 20% rate. But if anyone did, then you obviously need to remember to put your prices back up. Otherwise, you're going to be ending up with an unexpected VAT bill. If anyone is operating tills and accounting systems, they'll need to be reconfigured. Changes to EPOS systems, online booking engines, back office functions, all of those things need to be adapted and prepared. If you've got invoice templates showing the 5%, again, you just need to take a step back and amend those invoices. And broadly, you need to make sure that you're applying the correct VAT rate, especially if you have a VAT return that straddles that 31st of March period. And if you've got a period that goes from February to April, you're going to have some suppliers potentially at 5%, some suppliers at 20%. And then finally, if you're using a special retail or accounting scheme, again, do you need to amend that to reflect the fact that actually we're moving back from 5% to 20%? And I suppose I should put a word of caution out there about the 20% in itself. You know, we've got a budget coming up at some point next month. No doubt government is a bit short of cash with all the money that COVID is costing us. Will there be a change in the VAT rate? I don't know, I hope not, but again, something to keep a close eye on. Okay, next slide, please. Again, something that was introduced when the COVID pandemic first started, and again, it seems like a distant memory, but something just to be aware of. There was a suspension, or there was a provision there to allow you to defer your VAT payments between the 20th of March and 30th of June 2020. And the idea was that that deferred VAT was paid before the 31st of March. So you've got a couple of options now. Either pay that outstanding VAT to revenue by the 31st of March, or what you can do is apply to join a new payment deferral scheme that's opening up next week on the 23rd and closes on the 21st of June. Another alternative may be to ask revenue for time to pay arrangements if you're having real financial difficulties. But if you don't adopt one of these changes, you may be liable to interest or penalties if you haven't sorted your affairs out or made a decision before the 31st. So if we can have a quick look at what the new payment scheme actually is, that's on the next slide, please, Dan. What the new payment scheme does, it allows you to defer your payment over a 2 to 11 month period. It's allowing you to have further instalments, but you do have to apply to join this new scheme if that's what you want to do. To join the scheme, you need to apply online, but before joining, you must be up to date with your VAT returns. You've got until the 21st of June to join, and you have to pay your first instalment when you join, and then you need to pay the rest of them by direct debits. Okay, if you can't use direct debits for some reason, then there is what Revenue have called the whole COVID-19 helpline. I've not tried to get through to that helpline. Normally when I try to get hold of Revenue, I just end up somewhere in the ether. But they've been quite good with COVID, in fairness, so maybe if you do ring that number if you need to, maybe you'll get through. Now, as I say, the scheme opens on the 23rd of February, and Revenue apparently say there'll be an advisor there to help you join the scheme if that's what you need to do. Okay. Next slide, please, Dan. Okay, Brexit. Now, where do I start on Brexit? I'm not going to go right through the changes because, again, Revenue in their wisdom decided to issue so much guidance and publication during the Christmas period, it was almost impossible. Well, it is impossible to read it all. There's so much guidance, keeping up to date, and it's still changing, has proved a bit difficult. So what I want to try and do in the next 5 minutes, 10 minutes or so is just go through some of the main changes with you. And then all I can say is you'll need to take detailed advice as and when you can, if there's a particular situation that impacts on your organisation. So we're out of the EU, and so therefore we're out of the so-called single market. So the first thing that we need to think about doing is we're going to have to complete customs declarations. And that's both for our imports and our exports. Now, we're told that there is a trade and cooperation agreement. And I've said, is that just an illusion? Because what does that actually mean? It sounds great to say that we've reached an agreement, but actually when you drill down and start looking at the detail, actually it's quite onerous and there are a lot of conditions to meet. And the first thing that we need to be aware of, in order to have a situation where you don't have to worry about paying customs duty on the importation of goods, you need to satisfy something called the rules of origin. And so we only have free movement of free movement of goods, trade and goods, if the goods have either been manufactured in the UK or they've been manufactured in the EU. Now, I have to hold my hand up and say, back in the grim and distant past, before being a VAT officer, I was actually an inland customs officer for my sins. So I worked on both sides of that evil fence for revenue. And so I do have some knowledge of what the rules of origin are. And they are very complex. What you need to do is consider where a particular item originated and where the component parts originated from. So if you looked at, if you looked at a BMW car, you may think it's been manufactured in Germany and therefore rules of origin will apply. But actually, when you look at that car, it may be that the engine parts came from China. It may be they came from somewhere outside of the EU. Bosch appliances, for example, when you look at a Bosch appliance, most of them say made in Turkey, but most people associate Bosch with Germany. So what the rules of origin mean that you have to do is actually work out where those goods have been manufactured. And in order to benefit from a reduced rate of duty or no duty, you'll need to get a declaration from the supplier confirming that the rules of origin have been satisfied. And unfortunately, it's one of these situations where there's different rules of origin depending on which goods we're talking about. Every single item in the world has what's called a trade classification number, and that trade classification number will dictate what rate of duty is payable. Now, when you add into the mix that you have something called tariff quotas, what are tariff quotas? What that allows is a situation where, you could have £1 million worth of goods imported from China subject to no rate of duty, but once you reach that £1 million threshold, a tariff quota kicks in and suddenly duty applies. So everybody needs to become aware that this so-called trade and cooperation agreement does have a sting in the tail. You need to find out precisely what the relevant rules are, and there may even be licensing requirements. So you'll need a special license to actually be able to move goods. I've got one particular client at the moment importing, I know it's an odd subject, but importing blood and associated materials. The provision of blood in the UK is exempt. However, when you look at the trade classification number, you've got different trade classifications, and they seem to imply that actually there's VAT on that kind of importation. So we're trying to get clarity from revenue. And I can see this being replicated with lots of different goods. Now, the first thing you need to concern yourself with if you're importing goods from the EU to Great Britain is you need a UK EORI number. You also need to consider who's going to complete that customs declaration. will you need a customs agent? Will you need a freight forwarder? I wouldn't necessarily advise that you try and do it yourselves. You're bound to run into problems, especially when it comes to trying to work out what the trade classification is of your goods. So that's one decision you need to think about. Next slide, please. If you're bringing goods into the UK, you've now got import VAT to worry about, as well as customs duty. And just a word of warning on customs duty. Customs duty is payable on the VAT inclusive price, so it's the net price plus the import VAT, and that's the value that's used to work out what the customs duty might be. Now, it's payable at the point of entry, unless you're approved to use duty deferment, or if you're going to use postponed VAT accounting. Now, what does postponed VAT accounting allow you to do? Well, it allows you to account for the import VAT in box 1 of your VAT return, and then reclaim that VAT in box 4 of your VAT return. Now, interestingly, Revenue have for some reason turned around and said if you're importing goods that are going to be used solely for non-business purposes, you can't use postponed VAT accounting. Now, I don't understand the reason for that. And I don't understand what the problem would be in accounting for VAT in box 1 and just not recovering anything in box 4. But that's certainly what customs guidance says. If you're importing goods solely for a non-business purpose, for some reason you can't use postponed VAT accounting, which means you'd have to pay the import VAT before your goods are released. Now, if you're going to use postponed VAT accounting, you need to register with Revenue in order to get a monthly certificate confirming the amount of VAT that's been postponed. If you don't use that particular option, then you need to get your C79, which is your certificate of VAT paid from Revenue. Next slide, please. If you have consignments that are less than £135, then the good news is that there's no customs duty. But if you have an overseas supplier supplying goods to UK consumers, the overseas supplier has to register an account for VAT, UK VAT. So suddenly things have become more expensive. If things are being sold via an online marketplace, then the online marketplace has to account for the VAT. If the transaction is to another business, so a B2B supply, then as long as the UK VAT number has been provided, the importer has provided the UK VAT number to the supplier, then the UK customer will account for VAT under the reverse charge. For goods sold to the EU, if it's business to business, again, we need to have customs declarations. And unfortunately, depending on the mode of transport, those declarations will vary depending on whether the goods are travelling by post, road, air, and indeed what the goods might be. There might be licensing requirements. Similarly, if you're sending goods overseas, what are the terms of trade? What are the so-called INCO terms? Who's responsible for clearing the goods in that country? Is it the supplier? Is it the customer? If you leave it for the customer, you might find that customer saying, actually, I don't want these goods. I didn't realise I have to pay duty and VAT. Can you send them back, please? So again, that's something you need to consider if you're trading with other, well, I almost said other EU member states, with other countries. Sorry, next slide, please. Because of this, some suppliers have taken the view that the best thing for them to do is actually register for VAT within an EU country, or actually appoint a fiscal representative in an EU country that can actually take care of the compliance needed. Now, evidence of export is always needed to support any zero rating that you may have, and that's actually quite an important point. Evidence of export, the requirements of evidence of export set out in a particular notice 703. And again, going back to my days as an inland customs officer, one of the issues that you always needed to be aware of is some of those public notices actually cover the force of law. And one of the requirements in order for evidence of export to be acceptable is that it shows all the correct values. Just demonstrating that goods have gone from A to B isn't necessarily sufficient to be able to allow for zero rating. I did have a situation where a particular exporter was sending goods to Italy, and because the Italian customer wanted to pay less customs duty, they asked for the valuation to be different from what it actually was. The UK supplier thought, well, the goods are moving from A to B at zero rated. It doesn't make any difference to me. Yes, I'll go along with that. Unfortunately for them, that was picked up by Revenue, and they actually appealed the case to the tribunal and lost. They weren't allowed zero rating because they'd shown an incorrect value on their export documents. So please make sure that your export documents are correct. Okay, up to 30th of June, supplies of goods with a value less than 150 euros to EU consumers will be liable to VAT in the EU. So again, that may make the goods more expensive. From 1st of July, you've got the import one-stop shop being introduced, and that basically means that a GB supplier can register in a single EU country and account for VAT in that particular country. Okay, it saves you having to register right across Europe, but that's not coming in until the 1st of July. There's also the introduction of a non-union one-stop shop for all services, where again the place of supply is Europe. So from 1st of July, if you're supplying services to EU customers, potentially you can register in an EU country, just one EU country, and account for VAT on all your transactions throughout all EU countries. Next slide, please. Now, supplies of services from 1st of July are mostly the same. However, in respect of digital services, between the period 1st of Jan to 30th of June, you can't use the mini one-stop shop. Okay, so any organisations that currently are supplying digital services, you need to register for a non-union MOS in an EU country. And most clients that I've spoken to have all chosen to register in Ireland, mainly because they speak the same language as us. You can do it online. It seems to be a pretty quick process. So anyone supplying digital services, please be aware that you need to be registered. From the 1st of July, you can use the one-stop shop that's been extended to services. Now, with regard to digital services, one practical point to be aware of, unfortunately, there seems to be a different interpretation and definition of what a digital service is right across the globe. And the result of that is, unfortunately, you need to check the rules in each country because you might be crystallising an obligation to register. In terms of intangible services such as consultancy, advisory, marketing type services, well, the good news is from 1st of January, you don't have to charge your customer VAT. So if, for example, I was providing VAT consultancy services to a consumer in France, last year I would have had to have charged them UK VAT. From this year, because we're now outside of the EU, I don't have to charge that individual VAT. What I need to be aware of is, do I crystallise an obligation to register in that EU country? And then finally, I've got TOMS, Tour Operators Margin Scheme, for those of you that aren't familiar with that phrase. As we're now outside of the EU, any supplies of tour operators margin scheme supplies are now zero rated. Okay, but again, this is a moving field. Germany recently announced that if anybody is supplying TOMS supplies in their particular country, yes, it might be zero rated from a UK perspective. However, Germany expects you to register for VAT in that country for that particular supply. Okay, next slide, please, Dan. That was a very, very quick run through Brexit. I think anybody who might be impacted on that, please do contact us and hopefully we can give you more detailed advice. Gosh, time flies and I'm having fun. I can see I've only got 5 minutes left here. Right, making tax digital. Soft landing period finishes on the 31st of March. For all VAT returns starting after that date, you must have digital links throughout your VAT accounting chain. What is a digital link? Well, I've put that there on my slide, and I think it's quite important to note that when you look at Revenue's VAT notice on this, you'll see that those 2 bullet points I have there are actually in a special box that says this section has the force of law, because I spent a bit of time trying to work out where the legislation was that identified what a digital link is. And actually it was staring me right in the face. It's actually in the public notice, because the public notice does have the force of law. Okay, so a digital link is an electronic or digital transfer or exchange of data between software programs, products or applications. Okay, next slide, please. Okay, now revenue also accept that digital links include the items I've listed there: emailing a spreadsheet containing digital records, transferring a set of digital records onto a portable device. That can also be treated as a digital link. And then you've got a couple of other points there: XML, CSV import and export, and downloading and uploading of files. Next slide, please. Okay, so what do we need to do? What do we need to be wary of? Well, revenue do accept that you can still carry out your partial exemption calculations and your capital goods scheme adjustments outside of the digital accounting. They haven't really clarified where we are on reverse charges. For anybody that's not ready, revenue have said you can apply for an extension, but there are very, very strict rules if they're going to allow you an extension. You have to at least demonstrate that you've made some effort to try and comply with the requirements from 1st of April. However, whether revenue will grant you that extension or not, I don't know. Details are in their notice. I know that digital links and what it actually means has caused a bit of a problem. I haven't got it here on my slides, but I saw yesterday that the charity tax group has announced that they're holding another webinar where they're going to have a guest speaker from revenue speaking specifically on digital links and what they constitute. And what they've tried to do is group these things into 5 categories. The kind of themes that they're looking at is the nature of a digital record, what is permitted as a digital link, when the digital journey actually starts, which I think is quite an interesting point, what manual adjustments are permitted, and what charities need to do that they're compliant. So for anyone who's a member of Charity Tax Group, that is actually taking place on the 25th of February. Okay, I think my next slide was questions, but I've only got a couple of minutes left. So I hope you've been asking questions as we go along. If you haven't and there's still some time, please do feel free to post questions. It doesn't look as I'm going to have time to take them today, but anybody that does post questions, the idea will be that we'll collate those questions into a spreadsheet. I'll provide you with some answers, and then we'll circulate all of those Q&As together with the slides and the recording of the webinar. And hopefully that will give you some comfort, or maybe even raise further questions that you need to come back to us on. But apologies that I've overrun. As you can see, I've had to go through quite a number of different topics, at the very least to create an awareness. And we wanted to keep in as much as we can so that there's something there for hopefully everyone that has attended. Okay, I think that's enough from me for this afternoon. Hopefully that's given you some food for thought. Thank you for listening, and as I say, if you've got any questions, then please do post them and we'll try our best to come back to you. Thank you, and please all stay safe. Thanks.